Hello and welcome to the Finance Quarter. I'm Andrew Robertson. The big banks are again taking heat for raising interest rates and axing jobs. For many observers, it's a sign that there's a lack of genuine competition in the Australian banking system. And that raises the question, how can that competition be restored? The big banks have all lifted their mortgage rates, claiming rising funding costs are hurting their profits. But another record result from the Commonwealth has critics questioning the truth of those claims.
I think most primary school kids could understand that you can't on one hand say, look, guys, it's terribly expensive out there, we're going to have to charge more for your lollies, whatever a kid would buy. But on the other hand saying, you know what, we're making record profits, whoopee, that's fantastic.
The numbers tend to support the view that Australia's big four banks are benefiting greatly from their oligopoly position. Return on shareholders' equity is a good measure of profitability. Commonwealth leads the way at nearly 20%, with NAB bringing up the rear at 12%. Bigger, equally stable overseas banks who compete in much more crowded markets don't earn the bumper returns of Australia's banks.
If the banks are government guaranteed, which they all agree they are, why do they need to generate 19-20% returns on shareholders' equity? Whereas government bonds are yielding 4 to 5%.
Christopher Joy says it's a situation which leaves all the other financial institutions in Australia with one hand tied behind their backs.
One of the solutions we've proposed is that the government guarantee that is provided to banks and deposit takers is priced the same for all institutions.
Christopher Joy works with Wizard Home Loans founder Mark Bouris at his latest venture, Yellow Brick Road. Mr Bouris says the key to that solution is for the quality of loans to be the focus of the government protection, not the institution offering the loan.
If we get the money the same price, we can actually really chop in hard to the retail price, like we did back in the 90s and the early 2000 period, where we took 20% market share from the banks, where in those days the banks actually competed for your business.
One man you'd also expect to be jumping up and down about the dominance of the big four banks is Mike Hurst, the managing director of second-tier player Bendigo and Adelaide Bank.
We are able to make inroads into the market share of other banks. Certainly we've been growing our representation quite significantly through our community bank model in the last 10 years, and that's starting to pay off.
He says the Big Four did get a free kick during the GFC funding crisis, but he's happy to accept the cards he's been dealt.
I don't believe they act as an oligopoly. I think it's up to every business that competes in a market to have a different value proposition that stands them out and gives them the opportunity to grow, and I believe we've got that.
Which is another way to generate competition, persuading Big Four customers to vote with their feet. Well, speaking of competition, as we all know, Woolies and Coles dominate much of the retail landscape in Australia. What many of us didn't know is that Woolies and Coles are among the biggest retailers in the world. According to financial services company Deloitte, Woolies is ranked 18 and Coles number 21. Well, the man who conducted the study for Deloitte is their global retail partner, Lawrence Hutter. Lawrence, Woolworths has sales of about $52 billion a year, but the world's biggest retailer, Walmart, has sales of $420 billion, yet has a smaller market share in the US than Woolworths does here. Is that an indication that consumers in the US may get a better deal than consumers in Australia?
I don't think so. What's clear about both markets is that retail competition is very intense, which, generally speaking, gives a very good deal to the consumer and the shopper. I don't think necessarily the different levels of concentration of the two markets make for a different value proposition to the consumer.
If you drill down into the numbers of Woolworths and Coles, they're discretionary-based department stores, Kmart, Target, Big W, and even if you look outside, Myer and David Jones are struggling to lift sales. How do discretionary retailers respond to the changing retail landscape?
Well, I think the more you look at discretionary spend versus, if you like, the spend you have to do on food and those sorts of things, then the more, if consumers feel less well off, then the more that comes under pressure. What's clear, though, is I think that in a world where consumers are ever more connected to each other and to where they choose to shop, there are ways in which discretionary retailers can capture and do very good business with consumers. We see significant growth in online, for example, even in those markets around the world where overall spend is pretty static. In most of the developed markets of the world, online continues, for example, to grow very fast.
Do you think bricks and mortar retailers are doing enough now to entice people to give up their time to come to their stores in the face of this internet competition?
I think that's a really good question. One of the things I think we are seeing now is an increasing recognition that the store purely as a destination where you go and acquire product is going to evolve. And increasingly, with online becoming a very attractive way of shopping, we're going to see retailers looking very much at enhancing the experience in store. People talk about theatre in store, but retail as an experience, as a leisure occasion, we think is going to become more and more important.
So cutting sales staff to try to cut costs wouldn't be the right way to go in your view?
Those are business model decisions, but by and large, I think we'll see retailers looking to differentiate themselves positively based on the in-store experience. Very often, in fact in most cases, the service element of that is going to be absolutely fundamental. So having the right sales staff, appropriately trained, welcoming and helping customers in store, they're not going to go away.
Internet sales are still less than 10% of total retail sales here in Australia, but they're growing fast. Now the genie is out of the bottle. How big do you think internet selling will become?
A lot bigger, but it's a dangerous oversimplification to just look at internet sales and think about what will be bought on the internet versus what in store. What we see increasingly is an interdependence between the use of the internet and the role of the store. Interestingly, one of the things that comes out of our research is that there is something like a 7-to-1 driver in terms of internet use versus in-store shopping, which says that actually 7 times as many inquiries are made on the internet as product is bought on the internet. The rest actually being driven through purchases that are made in store but informed by that internet-based research.
Well, just finally, if I ask you to look ahead, say 10, 20 years, how do you see the retail landscape changing in that time?
Oh, I think it'll change in a number of ways. I think the multi-channel, or what people sometimes call the omni-channel model now, will be much more pervasive. I think we'll see globally more retailers operating across many different markets, and I think we'll see some of the major pure play online retailers being even further up our list of the top 250 retailers than they are today.
Lawrence Hutter, thank you very much for your time.
It's a great pleasure.
Unemployment is a key indicator of the health of an economy, but all the headlines recently have been about companies axing jobs. Nationwide, though, employment remains strong, with the latest figures showing the jobless rate falling and new jobs being created. The big unknown, of course, is what lies ahead in 2012. We asked 5 leading economists to look into their crystal balls and tell us what they see in December.
Well, we have the unemployment rate at 5.75% at the end of 2012. I think what's happening right at the moment is really a replay of what happened a few years ago. Employers are responding to the uncertainties by freezing hiring, and so we've seen jobs growth stop as a result. But what they're actually finding is the demand for their product is holding up, and that means mass layoffs are unlikely. So against that sort of backdrop, the unemployment rate slowly creeps higher through 2012.
We're expecting unemployment to be around 6% at the end of the year, so less than 1% above where it is now. But it's just indicative of an economy that's slowing, that's growing a little bit below trend, that has some skill mismatches. The labour market will be, the mining sector will be looking for jobs but won't be able to fill them. Other parts will be weakening, so higher unemployment from where we are now.
I actually think the unemployment rate's going to be steady. It's going to be 5.5%. I believe there is actually strong demand for labour in Australia. If anything, there's going to be skill shortages, and that's a much better problem to have than the unemployment that we've seen in the Northern Hemisphere. For the most part, I think the Australian labour market is well performing, and if you compare it to Europe that's sluggish or America that's grossly unequal, and there hasn't been a real wage increase since 1990, Australia's actually got it right.
We see the unemployment rate around about 5.25%, which is pretty similar to where we are now. The main reason for that is with growth during the course of the year of about 3.25%. That's only trend, and so I think essentially what we've got is a labour market that essentially goes sideways during the course of the year.
We're looking for the unemployment rate to be around 5.25%. We do think it's going to drift up over the next 6 months to as high as 5.5, maybe a little bit higher. But again, as we get through the course of this year and we see some of the areas of consumer and housing start to stabilise, we do think the unemployment rate can drift down again. When we look across the business surveys, there does seem to be quite a lot of interest from businesses in employing people, so we are looking for the unemployment rate after some weakness to be around 5.25%.
And now for something completely different, a Chinese soap opera being made in Adelaide. It sounds unlikely, but the result could be a huge boost for South Australia's tourism industry. More than 100 million people are expected to watch the Australian-made episodes of one of China's most popular series.
When the first 20-episode season of Cherish Our Love Forever debuted in China 15 years ago, few of its viewers had heard of South Australia, much less been to the state on holiday. But now the growing ranks of China's urban middle classes are taking to international travel in droves, and they're on the lookout for new destinations.
It's grown 150% in visitors the past 5 years, so for us it's going to be an absolutely fantastic emerging market for the future.
The original series and a successful spin-off film followed the lives and loves of a group of Shanghai 20-somethings.
The series really focused on the love lives and studies of a small cast of characters. It was very popular with a whole generation of young people in China at the time.
Now Mr. Zhang says a new cast of characters is set to endear themselves to Chinese audiences, and he thinks South Australia provides the perfect backdrop.
Grapes, harvest, the whole process of making wine. We're looking at that as a theme for the new series, and where better to come.
Shooting at a range of locations around the state started several days ago, and some of China's emerging stars of the small screen say they like what they see.
The scenery here is so beautiful. We've been taking as many photos of the country as possible in our filming breaks.
The Tourism Commission hopes those impressions will be conveyed to millions when the series airs in China later this year.
Just wait for it. There will be tons of Chinese tourists coming to Adelaide, maybe in the second half of this year and into next year.
Well, let's hope the people of China like what they see. That's it for this edition of the Finance Quarter. As always, if you'd like to see any part of the program again, you can find us on the ABC News website. Just go to the business page and click on the Finance Quarter icon. If you'd like to contact us, we're on Twitter at the address on your screen now, or you can drop us an email at thefinancequarter@your.abc.net.au. Thank you for watching, and we'll see you next time on the Finance Quarter.